as Steve Cassidy's proxy.
Mr. James Levin.
Here.
Mr. Eddie Brown.
Here.
Mr. John Kelly.
Vincent Speciale is John Kelly's proxy.
Mr. James McGowan.
Here.
Mr. John Farina.
Here.
Mr. Paul Ferraro.
Here.
Mr. Thomas Dillon.
Here.
Commissioner Douglas White.
Here.
24 votes in a quorum, and we start the meeting.
So we're going to start with the public agenda first.
Yes, good morning. We're going to start with the book with the color photos. If anyone needs a copy, we have extras. I'd like to start on, and we're going to go through March with a hint of what's to come in April and May. So I'd like to start on page 31, what happened in March overall for the fund. March overall was a down month, slightly. So if you look, you'll see on the left, I'm on the page with the bar charts. You'll see it was a slightly down month, down 15 basis points, bringing the fiscal year-to-date return to 352. And let me give you some details about that, and we'll go a little further on that. So if you turn back a few pages, it's hard to see, but page 27, the page number is hard to see, it's a few pages before. The first set of numbers are the equity markets, and what drove the returns were equities were down, fixed income was up. So the Russell 3000 in the first section, you'll see was down 1.02%. The second section, EAFE was down, and emerging markets were down 1.5% approximately. Core plus 5 was up about 0.5%, and the high yield market was down by about 1.5%. And TIPS and convertible bonds were also down. REITs were up for the same reason that Core plus 5 was up. It's very tied to interest rates. Interest rates during that time went down. We'll talk about a little bit more what's happened since then. But the month was a down month. If you fast forward to April, and we'll have fuller information for the month of April next month. The next page, on page 29, you'll see was a positive month. Russell 3000 was up 45 basis points. But the real star was the next section, EAFE and emerging markets were up significantly, 4% for EAFE and over 7.5% for emerging markets. But a big part of that happened to be that the dollar, which was very strong for most of the year, which hurt returns overseas in our terms. So all things being equal, if the dollar strengthens and the euro or the yen declines, our returns are negative and can hurt unless it's over the return of the stock price is more than the decline in the currency. Interest rates also went up. You'll remember, and I'll show you the chart, interest rates, that using the 10-year as an example, long rates were in the 180s. It went up to about 220, while that caused the Core plus 5 to be down about 45 basis points. We're now at a higher, slightly higher yield. On the next page, you'll see that the riskier assets in fixed income, such as high yield and bank loans, were up about 1%. TIPS were up. Real estate, REITs, in terms of REITs, were down about 5% or nearly 6%, and that's because interest rates were down and they're tied to interest rates. Overall, in May was a very good month. You've been reading in the papers, and probably if you turn on the news, you'll see that the U.S. equity markets are at record highs. So while going back the next page, to page 31, you see that the fiscal year-to-date return through March for the first 3 quarters was 352, and we'll have the quarterly report for you next month for the quarter ending March. We ran the numbers this morning, and for FIRE, the return for April is not likely, it will be in the 4%, it will be 4+%, and return as of yesterday was in the 5s, it was in the low 5s. So we're getting close. Fiscal year to date, fiscal year to date. So the returns are slowly getting to where we want them to be for the fiscal year to date. We have another month and a week for the fiscal year, but at this point we're in probably the low 5s. On page 32, we show you where we're allocated versus policy. The pie chart on the top shows the market values and the percentages. On the bottom shows you where you are versus policy. And on the left side, on the bottom half of the page, shows you that we're very close to policy The, the, uh, the bar, the brackets show you the rebalancing ranges. We're very close to policy, and that's intentional. We actually did a small rebalancing in April where we sold, because the equities hit new highs, so we sold some equities in April. We put some of the money in cash and some in fixed income. And you'll see on the right side of the page, Core Plus 5 and TIPS are underweight and cash is overweight. The combination of the two, cash and underweight in the Core Plus 5, gives us a duration and yield, a duration that's similar to the Barclays aggregate. The yield is actually slightly higher, so it's in the concern that long rates rise, which eventually will happen, hopefully in our lifetimes. While the short-term pain will be there because when rates rise, bond prices go down. But we believe this is better than just being sitting ducks waiting for rates to rise and lose more money. We'd rather have a better mix. And once long rates start rising, as rates rise, the cash you'll see start coming down and being put back to work in the Core Plus 5. And the last thing, in gray, you see the cash at 4.4%. While it's labeled cash, most of it's really 2-year treasuries and agencies. So that's considered cash on our cash desk, but it's not really cash in the strict definition of cash. But it's very liquid, low duration, and earns better yield, obviously, than the 0% that cash would. A couple of charts to show you what's going on in the markets. There's been a very strong dollar. You saw the weakened price of oil. You saw the weakened euro. During the most recent weeks, the dollar weakened a bit. The price of oil went up, so if you take a look at page 17, you'll see, as of the date we did this, which was a week ago, the price of oil was about $60 a barrel, which was well off its low of 42. If you take a look at the very next page of volatility, the equity volatility is very low. That's usually a sign that the equity market is doing well. As far as fixed income, if you take a look at 10-year treasury rates on page 20, you'll see what I'm talking about. The 10-year treasury at the time that we did this a week ago was 222. It's roughly that today, give or take, but it's well off the low of 180, which was just a few months ago. What that means is as long rates rise, bond prices go down, and that's why we have the underweight in Core Plus 5 and TIPS, and the 2-year treasuries and agencies, which is categorized as cash. The combination of those two gives us a similar yield, but a better duration profile, meaning that when rates go up, we don't lose as much. And when rates go up, we'll reinvest and put the money to work at higher rates. A couple of other pages to point out. On page 37, you'll see the market value as of the end of March. I showed you that it was a very slight negative month. For March was down below the record high of the prior month. It's at 10,920. I can tell you we ran the numbers yesterday, and the number now is back above 11 billion. And if the month were to end today, it would be a new record high for the Fire Pension Fund, above 11 billion, just above the prior month in February, above that 11.032. The 10-year return, as shown on page 38, is 7.21%, and the actuary, I believe, would be happy about that. That is gross for public markets and net for, gross for public markets and net for private markets. And as Scott has mentioned before, for the June quarter, we expect to have the quarterly report that will show net of fees in all asset classes. The rest of the report shows each asset class and each of the managers versus their benchmark. But those are my prepared remarks for the month of March, as well as a hint of what's to come, which is good news for April and May to date. Any questions?
Please note for the record.
Next item on the agenda is ETIs. And Brian is here. Brian, want me to do that?
Just to note, we did have one trustee in
So my name is Brian Cook. I'm the director of the Economic Development Bureau. We are in charge of the ETI program for the 5 pension funds. And one of the requests we got for the trustee education was talk about what the pensions are doing for workforce housing. So this is in part to follow up on that. I'm going to run through what the program does, talk a little bit about the New York City market, and then talk about our individual programs. I'm used to a New York audience, so feel free to interrupt or ask questions along the way. It's really weird for me when things are too quiet. So let's just start. What are the economically targeted investments? The most important thing to note is, unlike the other people you hear, we are not actually an asset class. We're an investment strategy that can invest across any of the asset classes. What our goal is to reduce volatility in the pension funds, to get you safe and consistent returns. All investments that we make to that point must have a risk-adjusted rate of return equal to any other return you'd get in another asset class. And so when we take that volatility and that return together, it really lends us into investing a lot into affordable housing because of how the markets are sort of set up, the guarantees we can get. We must provide collateral benefits for low, middle, or moderate income New Yorkers. We do have a minimum investment of at least $20 million. We can invest up to 2% of the pension funds. And we have an open RFP so that if you want to propose, or if somebody were to propose something in an asset class that would normally have to go through a procurement, they can go through our RFP process. So if we jump to the next slide, what's the state of affordable housing in New York City? We've all heard a lot of these statistics. Apartments rents rose 75% in New York City from 2002 to 2012. That's compared to 44% for the rest of the country. And we've lost over 400,000 units that are affordable to people making less than $40,000 a year. This is in part compounded by wage stagnation, which we've all heard a lot about. So we have sort of a dual hit. We are making less money, and it costs more to live here. And there are a lot of theories behind what is keeping the market from sort of balancing out in a natural way that I could go into, but just want to highlight the two things that pretty much everyone agrees on is land costs are rising, as is construction. If we go to the next slide, I just want to give some definitions so that people understand what I mean when I describe what I mean. Affordable housing is, for the purpose of this conversation, anything with a regulatory agreement on it. So if a city agency says you have to be affordable to this income group, that's a regulatory agreement, that's affordable housing. Workforce housing has a little bit of a broader definition. Workforce housing can include sort of what they call the middle market housing, a lot of the rent stabilized units that are affordable but not necessarily have a regulatory agreement connected to them. Currently, the pension funds define affordable housing as being affordable to people making less than 200% of AMI. And I included the 100% marks in both income and rents on the bottom of the page. So if you want to think our maximum limit, you can double that. And if there are any questions on individual programs, they can run through those calculations. Yes?
On the first page, on the collateral, fourth bullet, collateral benefits, can you give me an example of a collateral benefit?
Absolutely. So a collateral benefit could include an affordable housing unit. So it's a benefit. What we're judging the investment on is not only whether or not the return is good, but also whether or not it's having some sort of benefit in the long term for the citizens of New York and for the trustees. It could also include jobs or anything of those natures. But I will note, we really haven't found a good investment with the right risk profile outside of affordable housing yet. Could include infrastructure. If I could make that work, I'd be very happy. And I just want to quickly highlight page 4, which I know needs to be expressed in a better graphic way. But what we have is on the left-hand side, the income of New Yorkers. On the right-hand side, the rents of New Yorkers. And if you sort of take a look at the rents on the right-hand side, at the very top of that slide, you'll notice everything is in decline in the net column. Whereas on the income side, we're actually gaining low-income New Yorkers. And this is sort of the best graphical or chartable way to explain the problems that we're running into. Jumping to the next slide. So what is being proposed right now? Page 5, we've all heard of the Housing New York plan that came out. 200,000 new units of affordable housing over 10 years. 60% of that's supposed to be in preservation. That could be either buildings that are currently occupied or just buildings that exist that are empty that we want to preserve the affordability for a longer term basis. And 40% of it's supposed to be new construction. The total plan is supposed to be about $41 billion, and 75% of that money is supposed to come from private investment. So when we break that down a little bit farther, we know HPD's planning on spending from fiscal year 2014 to 2018, $3.1 billion. And if we hold those ratios constant, that means the world that we have to invest in this market is about $9.3 billion over the next 4 years. And it's not just us. It's also every bank that needs credits for their Community Reinvestment Act, who need to invest in New York City. It's the nonprofits whose entire mission it is to build affordable housing. It's the private developers who have just found that it can be profitable. That's the market we're competing for. So how do we do this? On the very next slide, the 5 pension funds primarily invest in the 3 areas that are available for affordable housing. It's debt, it's long-term debt, it's construction debt, and it's equity. Equity and construction debt are the most risky, so you'll notice they're the smallest pieces of our pie, making up only about 12% of what we invest in. The rest of the investments are either in our long-term loan program, where we offer permanent takeouts, or on the secondary market. And between the two of them, we provide, on one hand, a very unique benefit in our long-term loan program with very consistent rates, while in the secondary market, we're able to be a little bit more flexible to the changing interest rate environment. So if we go to the next slide, I just want to start talking about the long-term loan program. This is, in some ways, the signature program of the office, in that we run it in-house for the most part. We only rely on outside originators who sell us loans that comply with our program, and we have a servicer to help us run the program. I'll kind of break down what those do as we go on. But here's some of the basic features you should know. When we purchase a long-term loan, it's 100% insured by government entity, Fannie Mae, REMEC, or a federal agency. What that means, if anything goes wrong with the loan, the pension fund does not lose a single dollar. So it's as safe as it can be. We would literally only be at risk if New York State itself went completely bankrupt, and in which case we'd probably have bigger problems than a few loans. We offer a interest rate lock up to 2 years in advance. Very few other people do this, and we can do it because we're long-term lenders. It also makes our program very attractive. We do charge fees for cancellations and things like that. So if a developer wants to lock with us, we don't give them a single dollar. We say, well, buy it in 2 years. They find a better interest rate. They pay us a fee for having created their interest rate ceiling. And these are some of the ways the program's able to generate money. And everything that we invest here pretty much has a regulatory agreement. There are a few of the older loans we have that didn't have when they were primarily rent stabilized. So I'm going to go through just a quick example of this, because this is sort of the bread and butter of the work the office does. So 533 Bay Street, this is a senior housing that in December we rate locked in Staten Island. I'm really happy about this because it's really hard to get investments in Staten Island. There just isn't that much work by HPD out there. It's 67 units for seniors making less than 50% of the AMI. They got state monies. They're getting an energy grant from the state. They're going to have a $14.1 million construction loan that they're getting from Wells Fargo. And while they're going to pay off most of that construction loan through low-income housing tax credits, the remaining $1.8 million will be sold to the pension system, and then we will hold that loan for the next, well, up to 30 years. Just show you what the process would be in this, so that, when we say in July they were awarded money, that allowed them to find their financing with Wells Fargo. They shopped around. Wells Fargo is one of our 11 permitted originators. They they rate locked the loan with us in 2014. By that I mean they reached out to us and said, we would like to buy this loan in 2 years at the rate you're offering today, and we said yes. They are now in construction, and in 2018 we will actually purchase the loan, and then after that we will service the loan along with our servicer on behalf of the pension systems. To give you a sense of just what happens in all this on page 10, and I won't go through every single thing, but through the big 4 steps. At the time of rate lock, we're pretty much looking to make sure that this loan complies with the programs as outlined by the board. Is it the right affordability levels? Is it the right size? Does it meet our requirements? At the time of purchase, we actually review all the legal documents, both from the business side that we work with as well as the general counsel's office. That means we go through any co-ops, any documents, we'll go through any mortgage documents. We're basically ensuring that our legal interests here are completely protected. We then, at that point, purchase the loan, and afterwards we service it. What our outside servicer does for us is things like they file the UCC that basically says we are the primary loan on the investment. They collect the rents, they collect the interest payments and the principal payments. But when if they have, say, a non-payment person, they have to reach out to us and we work out to decide what to do with the loan, if we can put it in workout, if we need to put it in workout, if we must foreclose. We also review all the use of building proceeds, insurance proceeds, things like that, protecting the asset in the end to ensure that it isn't getting misused, let's say, as is wont to happen. On page 11, the most important part of this is you can see the returns that FIRE's been getting. And right now we're over 8%. To me, the most important part of this is you see this sort of very consistent rate of return you're getting. That is what these types of programs are supposed to do. They normalize the investment for the portion we can get, allowing you to consider some riskier things in other areas while providing an actual benefit for New Yorkers. All right. If we go to the next slide, the secondary markets that we participate in. These are liquid. These are just like any other asset class you might invest in. AFLO and CIO HIT and RBC Access. RBC tends to focus on single-family homes. They have a little bit of leeway for multifamily. And AFLO CIO HIT builds union-only construction. And they primarily focus on larger developments, large Mitchell-Lamas, large new buildings, things of that nature. And both are able to sell their assets on the open market. So should we experience a big change in interest rates or things like that, they're actually sort of both are allowed to sell their interest rates on the open market. So because if interest rates rise, they're able to be much more responsive than our longer-term loan program, which is a buy and hold program. So where the long-term loan program, you might see when interest rates rise, a dip in returns, or when interest rates fall, a rise in returns. In the long run, that's going to be very consistent. Here, they have to be very responsive to the market, and that's why we have managers for these. To give you just 2 quick examples of the type of work they do, both AFLO and CIO HIT. Harry Smith Houses. It's actually one of the big affordable housing victories in New York City. It was part of the Mitchell-Lama program. It actually bought its way out of the Mitchell-Lama program, and then it bought its way back in. It got a tax exemption for 50 years. We are providing the construction loan to modernize and rehabilitate for $8 million. It's going to actually create 15 union construction jobs and help preserve these solidly middle-class housing that has existed for the last 30 years. On the new construction side, we have Hunters Point South, Building A. A lot of you might have seen the press about this as this was going through. $8.265 million in HDC bonds, 619 affordable housing units, all brand new. They have a range of income from the low to middle, from 50 to 165, and they have a 5% preference for municipal employees. So this is the type of thing we can do that directly benefits the members. And then quickly, if we take a look on page 16 and 17, or 15 and 16, sorry, we have the returns for both investments. The important thing here for me is that you'll notice AFLO CIO HIT measures itself against the Barclays Ag, which is our standard fixed income investment, which these would be classified. And both these investments are at or around the Barclays Ag. So it's very close to getting an index fund while, again, benefiting the residents, which has a longer-term benefit for the residents in New York City. And then second to last, on page 17, I just want to highlight you have 2 new programs that are starting to get baked right now. Last year, you agreed to reinvest in CPC's construction master repurchase facility. So over the last year, they've been purchasing up loans. They finance affordable housing through construction. We've about, all the pension funds have $40 million invested in this, so it's not a huge investment, but it's already starting to spin off investments into our long-term loan program, which is part of the benefit of investing in CPC. And then we have the equity programs, which invest in workforce housing. This is the Related and Sandy deal, Related and Hudson deals done just after Hurricane Sandy that are investing in workforce housing primarily in the outer boroughs. And the equity programs, I should note, are managed by BAM with consultation from ETI. And then the last slide on page 18, which is something I just want to highlight. This is the first time you've ever seen anything like this. This is actually the location of all your investments across the boroughs. We've been working very hard to try and modernize and in some cases actually correct the records we have about where our investments are so that we can start to show you on sort of a better way where the investments are actually accumulating. And in the, I hope in soon to have a better breakdown on each program so that you can take a look at where each one is actually benefiting. The thing I'll note is where you're seeing the large dark dots on these investments, a lot of that is AFL-CIO HIP because they invest in large Mitchell-Lama complexes that often take up an entire census tract. And then you'll notice there's some darker colors in both the South Bronx and in Harlem, and a lot of that is actually the long-term loan program. There's been a lot of affordable housing development that occurred out there because of the city selling off in-rem properties and vacant properties owned by the city over recent years. And Staten Island, most of our investments are actually in single-family homes. And that's sort of the overview of where we are. Happy to take any other questions. For those of you who have heard this multiple times, anything I've missed?
Any questions?
What's your, said probably not a lot to do with the subject. What's your view on rent control? You said like New York City's been up 75%. You read things where they're saying if they opened all those apartments up, there'd be more competition. Is that bull or is that?
So my feeling is it's both. And the reason being is that when I take a look at land prices and I take a look at construction starts, they almost always seem to move in unison. And I haven't done the statistical measure, so I can't actually say completely. But what that suggests to me is that as supply starts to go up, or as people start getting interested in construction, the current property owners start raising the price of their land because they think to themselves, well, hey, if the guy buying my property might be able to build a new building, why not get more money out for that? Part of the effect of that is once one property in a neighborhood rises its value of land, every landowner around there goes, oh, my property's worth more. And I think what you start to see these sort of cascade effects. And in the neighborhoods where we've seen a lot of rent stabilization sort of disappear, like a lot of Manhattan, a lot of Harlem, we're not seeing rents dropping. I mean, we all know Williamsburg and Greenpoint basically got decimated from the populations that were there. There are people who disagree with me. I'm solidly on the side of we need it to stabilize unless we can really find a way to fix the supply problem. And I don't think we can really do that as a city without focusing on city-owned land. Of course, like I said, the reason why I said there are a lot of theories, the other side of that theory I should note is people say get rid of all restrictions and eventually if people can't afford an apartment, no one will rent it and rents will drop. I just don't think we've ever seen that really happen in New York City, outside of mass tragedies or like in a localized area like Lower Manhattan around 9/11, and then we saw it rise again within 4 or 5 years.
Okay. No other questions? Thank you.
Thank you.
Next
Chris
item
Bach, the director. of
next
the
item is from the mayor's office.
Sorry.
Okay, folks, if you would turn to page 73 of the big book.
7-3.
7.3. There's a memo from us proposing that we direct our general consultant, NEPC, under the supervision of the Chief Investment Officer with the assistance of BAM, the Chief Actuary, and our asset class consultants to lead our board in a full asset allocation review. So hopefully folks have had a chance to review this, talked about it with a number of you, and you know, we think that the time is right for us to do an asset allocation review this year and to get the ball rolling today. So let me see if folks have comments or questions. And then there's a couple of questions in the memo itself that I'd like to pose to Doug and to Ben. Anybody want to say or comment or anything? So, I mean, I think what I would do is ask perhaps Doug to weigh in on the process. The way I would see it is that we take a vote today to direct the staff and the consultant to work on this, and we agree on a timeline when they would come back to us. I think it would be useful for us to schedule an education session with NEPC where they can take us through asset allocation and how it works, and then schedule an actual session later in the year for when everyone would come in, the actuary, the consultant, the BAM, and walk us through, you know, what potential asset allocation would look like, answer the questions in the memo, and engage in a discussion, you know, so that by later this year we can essentially vote on whether to retain our current asset allocation or whether to adopt some changes in what they would do.
Yeah, I think most people are anticipating that this would really take through the end of the year, you know, so we have time to really think it through and do it right.
So maybe we can ask the questions for Doug and for BAM. You know, how long do you think it would take to do an asset allocation review? Yeah, well, that's fine. So, Doug, what's your thinking?
So generally this takes, you know, with an education session, it would take kind of over a 2-month period. It usually takes us about a month or so to put together a full asset allocation presentation that's not tied to liabilities. And then we have a new actuary, so I, you know, would presumably want to be having some kind of introductory meeting with her in the next month or so, just to kind of just get an update on how her thinking coming into the position, and the fact that you pointed out that the 7% rate was set with kind of a deadline for mid next year, which would mean that having discussion in the, you know, the third or fourth quarter this year, so that the board knew what they wanted to do and had communicated with the actuary as well about what the plan was for presumably filing legislation in the 2016 session that would either put another rate in place or another, you know, time horizon for a rate. But also we could do the education session in June or July, and do the asset allocation in September or October, whatever the pleasure of the board is.
And another, so I guess I would suggest, but let me just ask BAM, if we could use the July meeting, which I think we have said now is going to be July 15th, to have NEPC come in and do an education session for the board about asset allocation. Does that make sense? Would that, and in terms of your schedule, do you feel like July would work?
July would work, and, you know, we have made that arrangement at other boards, so I think, you know, to kind of do it all in concert would be helpful for us.
So we're thinking about the July 15th board meeting.
The investment committee meeting, right? Okay.
To start taking a deeper dive on this topic.
And then I think the other question then is whether we would need to schedule a separate meeting just to do
asset allocation review in the fall, as opposed to trying to do it along with everything else that we have on the agenda for the investment committee. And that's probably a question for BAM, which I don't know that we have to answer today.
Yeah, I would say, maybe we can, when we do the deeper dive in July and figure out what the parameters are going to be, we'll also have a better idea of what the fall will look like.
Okay. So does that make sense to folks that in July we would make a determination as to whether to, schedule the asset allocation review, which might take several meetings, might not be a single meeting, but whether we schedule that as part of our regular investment committee, whether we need to schedule one or more separate meetings to do it.
Well, I think maybe it will depend on how our agenda looks in July.
Right.
And if we have a heavy agenda, then maybe it makes sense to do a separate meeting. But if it's a light agenda, probably get it in as one.
Right. Okay. Anything else, Doug? No? Okay. So then can we, I guess I can make it. I would then make a motion to enact this proposal, to direct the general consultant under the supervision of the CIO with the assistance of BAM, Chief Actuary, and the asset class consultants to lead the Fire Department Pension Fund Board in a full asset allocation review. Okay.
Are there any objections? Hearing none, motion passes.
Great. Thank you.
So we're gonna, at this point, make a motion to move out of the public session to the executive session.
So moved.
For a second? Any objections? Hearing none, motion passes. We're now in executive session.